Today's reading for you is Civilization, Modernization, Value Investment and China. The author is Li Lu, an asset manager of the Charlie Munger family and founder of Himalayan Capital. This book is published in 2020. So, it's not a new book. So, why do I really want to interpret this book for you now? There are two reasons. Only is that at present, many people are uncertain about the future macroeconomic environment of China. But this book can provide us with a big historical perspective, taking us to understand China's past 200 years from the perspective of the evolutionary history of human civilization, history, nearly 40 years of history, and future development trends. You will find that many of the questions we are confused about now, as the time dimension lengthens, the answers will naturally emerge. When I first read this book more than 2 years ago, the touch was not very deep. But when I reread it now, the feeling is very strong. Another reason is that in the course of my recent reading of the new book Munger's Way in 2023, I feel that Li Lu is a person who deserves to be known more. In 2004, Munger took a stake in Himalaya Capital managed by Li Lu. At present 2023, the Munger family holds a portfolio mainly of Berkshire stocks, market opener stocks, and also Chinese stocks through Li Lu's fund, Himalaya Capital. These three investments account for the vast majority and are very concentrated. Munger has held the portfolio for nearly 2 decades. In the Munger Way, I saw that in 2010, 2017, 2018, 2019, 2020 and other years, Munger talked about Li Lu and expressed his recognition of Li Lu. He said that in his life, he has only handed over the Munger family's money to an outsider, Li Lu. He has called Li Lu the Chinese version of Warren Buffett several times. Munger's firm optimism towards Li Lu made me intensely curious about this person. I don't want to stop at the level of understanding the general information, but want to study his thoughts, temperament, and values at a deeper level. After all, there is an important way to learn, which is to follow someone you admire very much. Read the books he recommends, and study those people he values, and Li Lu is the person I follow Munger's Way and want to explore further with you. Li Lu's experience is very interesting. He was born in 1966 and graduated from the Department of Physics of Nanjing University with a bachelor's degree. Later, he went to Columbia University in the US to further his studies and obtained 3 degrees at the same time, namely a bachelor's degree in economics, a master's degree in business administration, and a doctor of law. He was the first student in Columbia University history to obtain 3 degrees at the same time, and spoke at Columbia University's 1996 graduation ceremony, a student representative. While at Columbia, he attended a Buffett investment lecture. It was actually a misguided experience. You know, the English name Buffett is only 1 letter away from the English name of buffet, and the pronunciation is very similar. Li Lu was living on a budget at the time, and he thought the lecture would provide free food, so he went. And only then did he realize that he had made a mistake. However, that day, he reaped something much more precious than free food, and that was the philosophy of value investment that changed his life. Li Lu said that the things Buffett said gave him a sense of enlightenment. It turns out that a reader can successfully become rich from scratch by screening companies and growing with excellent companies. Li Lu knows that he does not have a rich family background, proud management skills, and is not sure to start a business. But studying the value of companies, studying complex business data and financial reports is his specialty. After that, Li Lu studied Buffett, Munger, and Berkshire for a whole year, and since then embarked on the path of value investment. After graduation, he became an investor, and a year later founded Himalayan Capital Management and set up his own mutual fund. Later, by chance, he was fortunate enough to meet Charlie Munger. In 2004, Munger became Li Lu's investment partner until now. At present, the scale of funds managed by Li Lu has far exceeded 10 billion yuan. So what does Munger's trusted investment partner have to say about wealth accumulation? Why does Munger call him China's Buffett? The answer lies in this book. The content layout of this book is a bit strange at first glance. The first half talks about Li Lu's views on the evolution of human civilization and the law of modern development. And the second half talks about value investment, which seems to be a split. But if you look closely, you will find that in fact, what Li Lu talked about in the second half, about value investment itself and how to accumulate wealth in China today, can be traced back to the source from his thinking on the history of human civilization, modernization, and economic development. The first part, for example, why did he choose value investment as a way to accumulate wealth? Although the idea originated from the Buffett lecture he overheard, it was his historical perspective that made him firm on this path. The starting point for his thinking is this question: if you are going to invest, what financial assets can make your wealth grow safely and reliably in the long run? Many people catch words like safe and secure, and the first thing that comes to mind may be cash, gold, and bonds. So let's stretch the timeline to see how they actually perform. Li Lu chose US data here because the US financial market matured early and can go back 200 years. Let's look at cash first. If you had $1 in 1802, how much would that dollar be worth in 2011, about 200 years later? The answer is 5 cents. That is, it lost 95% of its value. The reason, you can guess, is because of inflation. Let's look at gold again. There is a saying called gold in antiques in prosperous times, gold in troubled times. Precious metals, such as gold and silver, are often seen as a way to store value. So how much purchasing power can you buy gold for $1,200 years ago by 2010? The result is $3.12. The tripling in 200 years is estimated to be much lower than many people expected. Then look at bonds. They have performed much better than gold. Short-term bonds have risen 275 times in 200 years. Long-term bonds have risen more than 1,600 times. Sounds good enough already. Wait a minute, there's one more asset class we haven't looked at. It's stocks. If we invested $1 in the US stock market in 1802, what would it be worth 200 years later? Empirical data shows that $1.03 million, a fraction of which is greater than any other asset. This is still the result after deducting inflation. So, why have stocks achieved such amazing growth? An important reason is economic growth. The GDP of the US has grown by about 33,000 times over the past 200 years, an annualized rate of just over 3%. And how does economic growth come about? If you go to the micro level, it is actually the growth of the sales of each company in the market, which is an average increase of 3% per year. And the net profit of these companies generally grows faster than the sales growth, reaching 6% to 7%, and the value of the cash generated by the company itself will grow at the same rate. And these stocks in the stock market represent companies above a certain size in the market. The core value of stocks is that the growth of corporate profits themselves reflects today's value. So stock prices also showed an annualized growth rate of 6% to 7%. With the effect of compound interest, the final result is that the overall US stock index has increased by 1 million times in almost 200 years. So, if this is the case, does one want to gain wealth by investing in an aggregate stock index and waiting? Right or wrong? First of all, investing in stocks. This general direction is correct. Investing in the total stock index also has high returns in the long run. For example, as I said just now, the US stock market, in the past 200 years, the average annual return is almost 6% to 7%. From the data point of view, if the 200 years are divided into 3 stages, each stage has been more than 60 years. Then the average annual return of these 3 stages is almost 6% to 7%. But the question is, human life is limited. How many people can have a time horizon of more than 60 years? So, we still have to shorten the time period a little bit. The statistical results show that if we take 10 or 20 years as a period, then you will find that the situation has changed. The performance of the stock index at each stage is significantly different. For example, in the 19 years from 1946 to 1965, the average return of the US stock market was 10%, but in the next 15 years, 1966 to 1981, the average return was minus 0.5%. In the next 16 years, 1982 to 1999, it grew at an even higher rate, 13.6%, but in the next 13 years, from 2000 to 2012, the average rate of return became minus 0.1%. I have attached a table to the article. You can click on it when you have time. Table of U.S. stock market returns at different times from 1800 to 2012 source. Civilization, Modernization, Value Investment and China Li Lu. So what does this tell us? First, if you are a professional investor and manage a long-term fund, investing in stock indexes is a good choice. After all, in the long run, for example, more than 30 or 40 years, it will grow. Second, if you are an individual investor and your investment career is 10 or 20 years, it depends a little on luck whether you can make money investing in stock indexes. Catching up with bad times may really not make money. Third, if you say, I don't require that much return on investment, I just want to share in the overall benefits of economic growth, then investing in stock indexes is a rational choice. Because according to statistical results, as long as the economy is growing, the stock index will rise more and fall less on average at different stages. If you invest yourself, it is likely that you will not be able to keep up with the average performance of the stock index. Therefore, many financial professionals, including Buffett and Munger, will remind that for most individual investors, investing in large-cap index funds is the most appropriate choice. The fourth and final lesson, if you have higher yield requirements and have certain professional skills, you are willing to spend more time researching investments, then you can look for better ways to invest in addition to investing in stock indexes. Is there such a way? Li Lu said that in the past few decades, within the scope of his understanding, there are various practices in the investment field, and there is only one investment method that can use statistics to speak, and can really bring investors excellent returns for a long time. For example, many people may be confused by Buffett's circle of competence concept. How to determine your own circle of competence? Li Lu believes that it is actually not difficult. The most important thing about a circle of competence is a boundary. Ability without boundaries is not real ability. He talks about a simple criterion. If you have an opinion, you can't just say I think so. You have to be able to say at the same time that the opinion is not valid, and then it is a real opinion. If you come to a conclusion directly, there is a high probability that it will be wrong and will not stand the test. In addition, the concept of circle of competence also mentions that you need to seriously study a company and understand it. Li Lu also gave a suggestion. He said, I ask a researcher in my company to study a company, and the first thing I want to tell him is, suppose you have an uncle who you have never met and suddenly dies and leaves this company to you, and this company belongs to you 100%. What should you do? You have to do research with this mentality. This is based on psychology. People have a tendency to cherish themselves. Once you know something belongs to you, you will cherish it very much and be full of motivation to study it. Furthermore, Li Lu emphasized one of his views, that is, all these value investment concepts we mentioned earlier, together, actually constitute a right path to make money. What is the right path? It's this path. You dare to tell everyone without reservation, and everyone thinks you deserve the money you make through this path. But if you don't dare to say it with a clear conscience, or if you say it and everyone thinks you're a liar and opportunist, that's not the right path. Why is value investment the right path in itself? Because by investing in the ownership of the company, you are helping the company's market value to get closer to its true intrinsic value, and you are also helping the company grow, and the money you make over the long term is a share in the growth. of the company's intrinsic value, which is a win-win for you and the company. This may be a bit abstract. I will talk about the counter examples below, which are also mentioned by Li Lu in the book. The first example is that around 2006, 2 years before the U.S. subprime loan crisis, Li Lu noticed a product called credit default swap CDS on the market, which was also a trigger for the subsequent U.S. subprime loan crisis. We can simply understand it as a financial derivative. If there is widespread default in the U.S. mortgage market, its price will fall. At that time, some financial professionals, including Li Lu, had already seen the risks in the U.S. mortgage market. Some big bears started shorting CDS. Li Lu also wanted to go short, but Munger advised him not to do so. Why? Munger gave two reasons. First, if your analysis is correct, there will be two possibilities. One is that the financial institution that sold you the CDS product will go bankrupt and cannot afford to pay. The other is that the government will bail out these financial institutions. At that time, the money you earned was actually taxpayer money, and you would not be able to earn it with peace of mind. In Munger's view, this is not the right way. Second, let's say you don't care. You make a lot of money shorting, and then you keep looking for the next big deal, because that's human nature. And that also takes you off the right track. After listening to Munger's words, Li Lu gave up the idea. Munger's analysis is indeed accurate. In the 2008 financial crisis, the government bailed out those financial institutions. Some big bears fought to the gods. One of the biggest earners, John Paulson, made $20 billion, but since then, Paulson's fund has experienced many big losses and has even come to be called the big loser. In addition to the idea of shorting this time, Li Lu said that he really had the experience of shorting for 2 years, but he later gave up the idea of shorting completely. He figured out that instead of shorting, it is better to go long and share the benefits of growth. This also has a certain relationship with his historical perspective. From a historical perspective, since 1800, the human economy has been growing continuously on the whole, and this general trend is more conducive to going long than shorting. This is Li Lu's key choice for investing. Share the benefits of economic growth by going long and getting rich slowly over time, rather than seeking to get rich overnight by looking for big deals. This is also the choice of Buffett and Munger. In addition to short selling, Li Lu also talked about speculation. What is the difference between speculators and investors? Li Lu said that investors predict the future performance of a company, while speculators predict the short-term behavior of other participants in the stock market. Just now we said that value investment is to share the benefits of company growth, which is a win-win situation. However, speculators guess each other, which is actually a zero-sum game. That is to say, the profits and losses of all speculators buying and selling stocks in the market together must have a net worth of zero, which will not have any impact on the economy or the growth of the company's own profits. This is the biggest difference between speculation and investment. So after knowing this result, do you choose to be an investor or a speculator? Li Lu said that this is a personal choice. There is no good or bad. The only difference is its impact on society. Investors do put all elements of society into a positive cycle and help society enter modernization. The so-called modernization is actually a state in which the economy begins to enter a state of compound interest growth. So this goes back to Li's broader historical perspective beyond investing, which also led him to choose the path of value investment. Here he also mentioned an interesting point in passing. It is why index investing can also have good long-term returns. This is because, he said, index investing is basically the sum of all investors and speculators. If the final result of speculators goes to zero, then the result of index investing is actually the net result of the investor. Therefore, index investing can have long-term returns, but this can only happen in a modernized society. Modern economies can spontaneously generate progressive and sustained economic growth. and stock market indices can represent all companies of a certain size in the economy. In this case, index investing can basically reflect the general business performance of the economy and share in the benefits of growth. This line of thinking may also help us understand the advice of many investment gurus and professionals to amateur investors, that it is better to invest in indices than to toss themselves. Here he also mentioned an interesting point in passing. It is why index investing can also have good long-term returns. This is because, he said, index investing is basically the sum of all investors and speculators. If the final result of speculators goes to zero, then the result of index investing is actually the net result of the investor. Therefore, index investing can have long-term returns, but this can only happen in a modernized society. Modern economies can spontaneously generate progressive and sustained economic growth, and stock market indices can represent all companies of a certain size in the economy. In this case, index investing can basically reflect the general business performance of the economy and share in the benefits of growth. This line of thinking may also help us understand the advice of many investment gurus and professionals to amateur investors, that it is better to invest in indices than to toss themselves. The third part, well, what we mainly talked about earlier was Li Lu's understanding of value investment. In his understanding, there are not only the teachings of Graham, Buffett, and Munger, but also his own thoughts. Li Lu believes that all the concepts of value investment add up to actually constitute a road and right path to investment. This is not a moral preaching, but an insight into wealth growth through historical perspectives and real data. However, many friends may say, the analysis just now mainly used US data. Are these analyses applicable in China? Or, the road of value investment, does it work in China today? This question can actually be divided into two layers. We know that the main investment object of value investment is stocks, and it is to screen the excellent ones among listed companies. So what we should think about on the first level is, from a broad perspective, is it suitable to invest in stocks in China? On the second level, is it suitable to use the method of value investment to invest in stocks in China? Let's take a look at the first layer. Is it suitable to invest in stocks in China? As we mentioned earlier, the fundamental reason why stocks have been the most valuable asset in the US in the past 200 years is economic growth. Because the core of the value of stocks is the growth of corporate profits, and the growth of profits of each company, together, is the growth of the country's macroeconomy. So, if you want to know whether stock investment is still suitable in China today, what we actually want to ask is the prospect of China's future economic growth. You may have heard a lot of different arguments on this issue at the moment. Li Lu's choice is to take a longer perspective and look at the issue from the perspective of the evolution of human civilization. The source of his perspective is a fusion of three classic books: Guns, Germs and Steel, How Long Will the West Dominate, and The Measurement of Civilization. Li Lu divided the evolution of human civilization into three stages. Stage 1.0 was the hunter-gatherer civilization, which began 150,000 years ago, after the emergence of humans. Stage 2.0 was the agricultural civilization, which began around 9000 BC, when agriculture and animal husbandry first appeared in the two river basins. And it was not until more than 200 years ago, after the Industrial Revolution, that human civilization entered the 3.0 stage, which is the modernization stage. Li Lu also called it technological civilization. What is the biggest difference between civilization 3.0 and the previous two stages? It is the continuous and progressive growth of the entire economy. Before this, the economy often grew for a period of time, but a natural disaster, a war, and then went back. You should have seen that famous curve. Before 1800, the economic development curve of human society was basically a straight line. But after 1800, this line began to rise steeply and kept going up. Even the disasters of World War I and World War II could not stop this trend. It is only with such sustained and progressive economic growth that the investable value of modern financial products can we discuss asset allocation. Without this premise, this discussion is meaningless, because economic growth is the source of wealth creation. Li Lu has been thinking about this question for 30 years, and the answer he came up with is free market plus modern technology. He used two formulas to help us understand this process. The first formula is 1 plus 1 greater than 2. This represents the role of the free market. Adam Smith and Ricardo taught us that when society divides the division of labor, to economic individuals exchange freely and create much more value than they would otherwise have created. This kind of exchange also existed in the agricultural era. But after the emergence of modern technology, this free exchange has doubled to produce more added value, from 1 greater than 2 to 1 greater than 4. Because in addition to the exchange of goods and services, knowledge is also exchanged with each other. When two people discuss knowledge, they not only acquire each other's ideas, keep their own ideas, but also collide with some new sparks, which becomes 1 greater than 4. And modern technology allows such exchanges between individuals to be scaled up to billions of people, which forms the modern free market economy, which is Civilization 3.0, with continuous progressive economic growth. When did the US enter Civilization 3.0? It was after 1800. So, we will see the continuous growth of GDP after 1800, which led to the continuous rise of the stock market. And what about China? We have been under the impact of Civilization 3.0 since 1840. And we have tried several different paths in the middle. But in the end, after the reform and opening up of New China, we entered the right track of modern technology and free market economy, and entered the stage of continuous growth. And what does this reflect on the stock market? China only had a stock index in 1991. You will see that from 1991 to 2014, the overall performance of the stock market also rose rapidly, and at a faster rate than the US. China's stock index has risen 15 times in those 24 years, with an annualized return of 12%. That is, when China started to fit into Civilization 3.0, it behaved in almost the same way in terms of assets as other 3.0 civilizations. However, since 2014, the Chinese stock market has also experienced significant fluctuations, and now many people feel uncertain. So, what will the long-term trend be in the future? Judging from the experience of other 3.0 civilization countries, to think about this question, it is still necessary to go back to economic growth. Li Lu believes that the key to whether China's future economic growth can continue to grow is whether we will continue to walk on the path of Civilization 3.0, on the path of growth of the free market plus modern technology. Will it be? The answer given by Li Lu is positive. The key point here is that free market economies have scale effects. The more people who participate in free exchange and the larger the market, the more scale advantages there are. It's similar to an online platform. The more people use it, the more people will join in. The same is true of free market economies. So, an important corollary comes. In the end, the biggest market becomes the only market. This situation has obviously already happened. In the early 1990s, with the fall of the Berlin Wall and China's full embrace of the market economy, mankind began to enter the era of globalization, and the global market was formed. In this case, any economy that comes out on its own will form a relatively small market, which will inevitably become more and more backward after running for a period of time, and the economy will stagnate. In a mature country like China with a successful history and cultural precipitation, this situation is unacceptable to the vast majority of people. Any brief departure from the global market and deviation from Civilization 3.0, if it occurs, will soon be corrected. In addition, in some interviews in 2021 and 2022, Li Lu also talked about his views on the challenges of globalization from 2020 onwards. He believes that today, globalization is indeed challenged to a certain extent, but the contributions and benefits created by globalization itself are large enough to absorb these negative effects. This is the global level. At the national level, is it possible for a country to change the game now and turn the world economy back from globalization? Li Lu thinks it is unlikely, although today's international economic order was created by the US after the war. But, like a startup company, when the company grows to a certain stage, the company itself has life, and the influence of the founder will decline. Today in the global market, all countries are stakeholders. The founder is no longer the only voter, and the founder's stock has been diluted. Therefore, the basic trajectory of the global free market will not change. So, if this is the case, the performance of China's major asset classes in the future, such as stocks, cash, bonds, etc., will generally follow the basic model of the mature market economy countries in the past 200 years. And the performance of stocks will still outperform other major financial assets. Well, here we have answered the first layer of questions. In the future of China, is it still suitable for stock investment? Let's look at the second layer. In China, to do stock investment, is it suitable to use the value investment method? When we talked about why Li Lu thinks value investment is the right way earlier, we have already answered most of this question. When you do value investment, it is equivalent to choosing the best from the general trend of economic growth, and selecting those companies with the best growth potential to share their value growth. This is of course a dominant strategy. Moreover, Charlie Munger and Li Lu both believe that at this stage, there are more opportunities to do value investment in China than in the US. At the 2022 Daily Journal Share Owner Conference, in the face of some share owners' views that China is not suitable for investment, Munger said, "Who is right and who is wrong can only be tested by time." The reason why we spend a lot of money to invest in China is because compared with the investment opportunities in the US, the investment opportunities in China are better. We can buy at a cheaper price, get higher company value and faster growth rate. We are not the only ones investing in China. Sequoia, the best venture capital firm in the US, has also invested in China. Li Lu also added a perspective. He believes that compared with Western developed countries, China's capital markets not mature enough today, but this gives value investors more advantages in China. Because today, most of China's capital markets are still retail investors, and they are still mainly short-term traders. Even institutions still focus on short-term trading. Prices often deviate from intrinsic value on a large scale, which will generate more unique investment opportunities. Therefore, if an investor cannot be fooled by short-term exchanges and truly adhere to long-term value investment, then you will have fewer competitors and a higher probability of success. Conclusion. Okay, so that's what I want to share with you in this book. Finally, I want to add something to you, which is what Li Lu also talked about in the book. If an ordinary person doesn't want to or is not good at doing value investment, then how can he keep his own wealth? First, if there are no good investment opportunities, holding cash or money funds is also an option, better than spending money to speculate. That's what Buffett does. Berkshire often keeps a lot of cash on its books. Of course, this also allows him to move quickly when he sees an opportunity. Second, the phrase we often mention, which has been suggested by many professionals, is to invest in the broader market index. This is a good choice when the index roughly reflects the average performance of the entire economy. Third, if you buy stocks, then remember, do not participate in short-term speculation. This is the most basic principle. Only invest in what you know. Do not touch what you do not know. Fourth, if you are not sure about your ability, then give your money to excellent professional investors to take care of. That is, give things outside your circle of competence to people who have the ability to do it. Regarding how to screen professional investors, You can click on the ebook at the end of the manuscript and search for the keyword "Find Excellent Investors" to see Li Lu's detailed instructions. Okay, let's stop talking about this book today. You can click Documents below the audio to view the full text and brain map. And you are also welcome to click the share button in the upper right corner to share this book with your friends for free.